Tuesday, February 21st, 2023, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at how the CPI is going to be tinkered with even more and more regularly from 2023, and what that will mean for the CPI numbers, in my opinion, for the markets and for the general public, of course. Make sure you check out Miles Franklin. They have a special promotion on 2022 silver maple leaf coins. They're only $3.40 over spot. If you're interested, email them at info@milesfranklin.com or call them on 1-800-822-8080 and mention Monaco 64 as well if you do so. So before we look into this story that I found a few days ago about the CPI, and actually someone told me about it, I wasn't aware of it. You see, they do these things very sneakily. They don't want people to know that they're tinkering with the number. I like to say that, yes, the basket of goods and services, they change through the decades. Tastes change. But there is a limit to how much you can change in the basket in the short term. You should go to shadowstats.com. John Williams talks about how they've changed the methodology of CPI over the decades, how if we calculated CPI, how they did it in 1980, we would be with the CPI in double digits. So why is this so important, the CPI? And I've said, of course, that CPI is not inflation. CPI is the consumer price index. And I've said many times, of course, that inflation is the exorbitant or the massive creation of currency and credit out of thin air. In a fiat currency system, you always get inflation because the government and the central bank, they don't have the discipline of real money. They can just issue currency and credit at will. They use the fractional reserve mechanism as well. And unless we want to go back to sound money, we will never see really the inflation stop. Granted, the M2 has come down in the last year, but prices are still rising, consumer prices that is. And inflation results in higher prices, not just of consumer products or goods and services, but also of asset prices. That's the other thing people don't talk about. When the NASDAQ or real estate or the Dow go up a lot, they don't call that inflation. And in a way, they're right. But when consumer prices go up, they call it inflation. But it's just prices rising. And what that does, it gives the central bank the excuse to inflate even more, because if they tinker with this CPI and everyone believes, even the people in the markets, the mainstream Keynesian economists, if they believe that it's inflation, they will keep financing the government at lower rates. But the people that get really hurt are savers and the general public. The people at the top of the wealth like ladder, so to speak, they can do well in inflation because they have a lot of assets. So yes, I agree, the tastes change, but what you're gonna see here through this story is, in my opinion, it's gonna lead to a lot of tinkering, as I said, and the tinkering, you can bet, will be on the downside. So the story is from marketplace.org, and it's from February 14th. And it says something's different about the consumer price index this month. So let's go through it and you'll see what they're doing now to the CPI. January's consumer price index report released Tuesday was a bit of a mixed bag. Prices were up 6.4% since the same time last year, making January the 7th straight month of cooling year-over-year inflation since the CPI peaked at 9.1% over the summer. So they use the word inflation. I'm not going to go into it. Just wanted to show you what's going on. But on a month-to-month basis, prices actually spiked 0.5%, fueled by rising cost of food, housing, and gasoline. Another thing changed between the December and January reports. Well, the formula the Bureau of Labor Statistics uses to calculate the headline number, that's changed. Did you know that? The folks at the BLS aren't just tasked with measuring economic changes. They also have to make sure their tools keep up with the times. So this is a big reason why their jobs are hard, said Wendy Edelberg of the Brookings Institution. Tracking the changing cost of things like food, rent, and energy is half the battle, she said. That's only meaningful really if we talk about how important each one of these things is to you, to your family budget. The formula that price changes are plugged into needs to reflect how consumers are actually spending their money, Edelberg added. For a while, the BLS has adjusted the items in its metaphorical basket of goods and the weight assigned to each item every 2 years, said former BLS Commissioner Erica Grosjean. It's now going to update that market basket every year, she said. It is also going to use consumer spending data from just one calendar year rather than the average of 2. And that's a very good thing, Grosjean said, because particularly in the time of rapid price changes or rapid price rises, people adjust what they spend on money. Yes, they do. They have to adjust downward. They have to buy things that are not as good, that is cheaper. So what I see happening here is a lot of substitution, and it will mask, of course, the debasement of the currency, the real inflation. So let's continue. According to her, more frequent updates based on more recent data will give us a more accurate snapshot of inflation. Well, what I think will happen as well is the packaging, when it shrinks, and then it's called shrinkflation. Let's say they shrunk a package 18 months ago with this new methodology. And I'm speculating because I'm not sure how that will work with the shrinkflation. But for example, they had a package of a good, let's say 10 ounces, and it was slashed 13 months ago to like 8 ounces. I can see them keeping the 8 ounces the normal, so people won't see the percentage rise in real terms because of the shrinkage of the package, and I think there will be a lot of that. It's important to try to get that number right, said BLS economist Jonathan Church, because the CPI is used to calculate a lot of other things, like cost of living adjustments for Social Security payments. Yes, and it's also used by employers a lot of time for pay rises and for the unions, for everything. And it's a very authoritative number. And who's going to benefit from these adjustments? Well, you can bet it's going to be the government.
In this present crisis, government is not the solution to our problem. Government is the problem.
They're not going to do these changes and make the number look bigger. They're trying to make it look smaller. Thousands and thousands of contracts throughout the U.S. in which wages or rents are tied to the CPI. There you go. Many states have laws that tie increases in minimum wages to the CPI, Church said. Plus, The index is one of the inflation measures the Federal Reserve uses to inform monetary policy. So there you go. You can bet over the months, over the next 12 months as well, maybe 18 months, the CPI, you will see a drop in CPI, and everyone's going to say, well, inflation is contained now, inflation has dropped. But I would venture to say that the bottom quintile of the public will still be suffering. And why is that? Well, because that bottom quintile, as you can see here, they spend a lot more on the basic necessities. This is from 2021, the lowest quintile of US households. They spend about 30% on food. And I would say they probably spend a lot more also on energy compared to the wealthier households. So these people are going to get hurt. The people on fixed income, the pensioners getting their paycheck from Uncle Sam, that's going to be that's going to be artificially kept low compared to the debasement of the currency. And yes, and I think that could help the Federal Reserve kind of pivot eventually. What you can count on is that the currency debasement, the inflation will continue, and you shouldn't fall into the trap of thinking that CPI is inflation. That's what they want you to think. And I think investors are going to be shortchanged as well. I've spoken about financial repression here in the UK. So what that will do is that bond investors, they're going to get a lot less return on their lending to the government or corporations through the bond market for the real level of currency debasement. So there you go. With that, let's look at where the markets are this morning. It's almost 8:30 a.m. London time. We've got spot gold at 1832.50. It's down just over $8. The low's been 31. The high's been 44. Spot silver is down 13 cents at 21.68. Low's been 63. The high 87. The Dow futures is down 50 points. NASDAQ 100 futures down 75. And the S&P is down about 13 points. To the currencies, sterling is down 0.1% at 120.25. The euro is unchanged, 106.80. The dollar is up 0.4 versus the yen at 134.80. And the dollar's up a third versus the yuan at 688. And quickly look at the ruble, because the ruble has come off quite a bit in the last few months. It's come off about 25%. And what do I think is happening there? Well, I think the Russian government and central bank, they're allowing the ruble to devalue a little bit. Because it makes their imports look a little more valuable in their local currency. It is kind of a zero-sum game, but it helps them keep their domestic financing going. But it is inflationary, of course. So right now we're trading at 75 rubles to the dollar. I remember last year the ruble was pretty much pegged around 60, but ever since the price caps that were imposed on oil and gas from Russia, the Russians have allowed the ruble to depreciate. So back to the other currencies, we've got the Aussie dollar down 0.5% at 68.70. We've got the dollar up 0.2 versus the Canadian dollar at 134.78. We got the Kiwi dollar down just over 0.5% at 62.14. To the commodities now, we've got platinum down a couple of dollars, trading around 927. We've got WTI crude down a third at 77.12. Brent is down a third as well at 83.50. So we're going to look at the bond markets now. The 10-year U.S. Treasury yield is up 5 basis points. It's trading just below 3.9%. Interestingly, the 6-month T-bill is trading above 5%. It's at 5.05. To the UK gilt market or government bond market, we're continuing to see yields rise. They came off slightly yesterday in the short end, but right now the 2-year yield is at 3.81. That's up 6.5 basis points. The 10-year is up 7 at 3.54. And the 30-year is up 7 as well, approaching the 4% level. And last but not least, to the biggest Ponzi bond market in the world, the Japanese government bond market. Well, the 10-year yield there is still stuck at 0.5%, but I see that it's traded above that level today, so they're having a little more difficulty keeping it there. It's traded just above there during the day. We'll have to keep an eye on that. So with that, I'm going to wish you all a very good day and a very good start to the week for my viewers in the US. I know it was a public holiday yesterday. It was President's Day or Washington's birthday. Washington's birthday actually is tomorrow, the 22nd of February. And that as well is in the new calendar, Gregorian calendar. Prior to that, I think when he was born, it was February 11th. So, yeah. And I'll talk to you later. Take care. Bye.